Thank you. Good morning. I don't know how many of you watched the rather farcical ending to the Oscars a couple of nights ago, but it kind of reminded me of the state of politics in Washington right now, because the final two choices were between Moonlight and La La Land. And the only other alternative out there was Whiplash. So for me, the state of global politics that I see, and that the editor-in-chief of The Economist was talking about this morning, is very symptomatic of the sort of thought processes that have sort of obsessed the private equity industry over the course of the last couple of decades, which is, are emerging markets full of risk? Are emerging markets where we need to be careful? And where is the next set of risks going to come from? Well, I inhabit a world where actually when I look outwards towards Washington, London, and Europe, I see a lot of risk. I see a lot of issues cropping up that cause uncertainty in the investment climate. And as far as I'm concerned, I look at the world that is inhabited by the rest of the planet, and I think to myself, when will this roller coaster stop? What are the issues that are going to hold us up? And I'm here to postulate to you that there has never been a better time than now to invest into what we call the global growth markets, and many still mistakenly call the emerging markets. There have been fundamental internal changes that have been taking place in these markets, in the countries that they represent, in the cities that are inhabited by these markets, in the economies where, independent of everything else that is happening around the world, these markets continue to grow. Now, you can't look at them in isolation, because obviously what happens in Europe, what happens in the US, will continue to have an impact on what happens in emerging markets. And the reality is that whether it is nationalism, whether it is populism, whether it's isolationism, whatever it is that is happening in this part of the world, the impact by definition is going to be felt elsewhere as well. But let's take a quick look and have a, oops, that wasn't me, and have a look-see at what actually these markets represent. What are these economic forces at play that are out there? Global growth markets today make up 2/3 of the world's growth, of global GDP, and 3/4 of global GDP growth actually, and 2/3 of global GDP. And this is not just today, but it's the actual fact that is going to be prevalent over the next 15 years or so. Close to 60% of global consumer growth is going to happen in these markets, and they're going to outpace developed markets at a ratio of 3:1. They're going to bring an additional billion people into urban centers around the world. Mankind has become an urbanized race for the very first time over the course of the last few years, and this number is going to grow. So 1 billion new people in urban cities in these markets. This is the equivalent of 8 New York cities a year forming from scratch. 700 million of these people are going to be at a working age population. These are enormous numbers. And yet, when we look at these markets together, I fear that we can get into the danger of bracketing them all as one bucket. We don't do that at Abraaj. We disaggregate these markets, and we disaggregate them into what I call the 3 Cs. And what are the 3 Cs? Let's disaggregate the markets between China, which is a world and a life force of its own, the commodity-producing economies, and the consumption-driven economies. Let's focus on China first. China is a nation that actually is a bit of a law unto itself. It has grown at a remarkable pace over the last decade and a half, and it has resulted in 800 million people coming out of poverty within China itself. It's been growing at a rate that has kept the global economy buoyant as well over this period. China has experienced over the last 15 years an investment-led growth that was focused on infrastructure. And now it's turning its economy around. Imagine an elephant turning around in a room of this size. It's turning its economy around from an investment-led growth into a consumption-driven economy. And of course, it will take time. But in the meantime, they've hit upon a brilliant formula, which is to transform that investment-led growth into the countries around them through the One Belt, One Road policy. And that is the equivalent of 15 Marshall Plans. Imagine what one Marshall Plan did to Europe at the end of the Second World War. These are 15 Marshall Plans being implemented together across Vietnam, Bangladesh, India, Pakistan, Kenya, and 40 other countries that China considers to be strategically important. So I think that's a smart strategy and an interesting one. You have to look at China on its own. And the most interesting thing that I found was, for those of you who were in Davos this January, the Chinese president walked into the room, came into what was perceived to be a political vacuum, and the leader of a communist, totalitarian, reasonably sort of economy is talking about globalization and becoming the champion of capitalism. So the world is turning around on its head, and let's look at China in isolation and not part of emerging markets or global growth markets, because they're shortly about to become the second largest economy in the world. Let's look at the other two buckets. The commodity-driven economies should actually have their currency as the US dollar. They're all linked to the dollar. They go up and down. Their volatility is an exhibit directly of the commodity pricing volatility that the world experiences. And this is not about to stop anytime soon, whether you're producing copper, tin, or oil. And these economies actually, to a large extent, have not yet properly reformed either. And that has been a function of the fact that these commodity price booms over the last couple of decades have not led to governance reform, have not led to political reform, and these nations are kind of lagging behind the opportunity curve that is present in global growth markets. But the real opportunity, the actual opportunity, is in the consumer-driven economies. These are about 40, 45 countries around the world that are exhibiting enormous growth opportunity. It's exhibiting it on the back of consumption driven by young populations, emerging middle classes, and economies that have already experienced the first phase of governance reform. Now, it's quite interesting when you think about the average age in these economies. It's 28. The average age in OECD countries is 40. What happens when you're 40? You start thinking about spectacles, pharmaceuticals, saving rates, and so on. When you're 26 or 28, all you want to do is spend. And what do you want to spend it on? Consumption-driven opportunities. So the cities that are represented in these markets and the people moving into these cities present investment opportunities that are very clear, whether it's in financial services, logistics, healthcare, education, financial services, you name it. These opportunities aren't about to stop anytime soon. We at Abraaj have something called the Scooter Index that we use to monitor these economies very carefully. It's quite interesting because GDP indicators are not often the right way of evaluating how an economy is growing. A Scooter Index is, and if you measure what is the first conspicuous consumption that a person makes when they come into the emerging middle class, it's the scooter. It's the mechanism to get around, and often that indicates to us the speed at which an economy is going. But the point I was making, which is more relevant, is it's not just about the type of consumption, it is about the speed of consumption as well, and the rate at which these economies are changing. Now, when we look at these markets and the fact that they represent the majority of global growth, who do you folks think have worked this out ahead of anybody else on the planet? It's the global consumer-driven companies that are listed in stock markets around the world, whether it's Unilever, whether it's Nestle, whether it's Kimberly-Clark, Colgate-Palmolive, you name the company. When you disaggregate their income statements, you'll actually find that 2/3 of their growth is coming from these markets. The highest proportion of their profitability is coming from these markets. And the fact that these markets are predominantly focusing around the urban environment makes it even more interesting, because the urban environments are growing greater than the country environments, often at a ratio of 2:1. And what do I mean by that? When you look at Indonesia, if Indonesia is growing at 4%, you can bet your bottom dollar that Jakarta is growing at 8%. The same ratio holds true in Lagos and Nigeria, in Istanbul and Turkey, in Mexico City and Mexico. So from an alternative asset management perspective, what you can actually very safely say is that there continue to be some fairly fundamental opportunities to invest in these markets on the back of this relatively unprecedented growth. Now, what that doesn't mean is that there isn't risk, and I will address that as I go along. But some statistics are very, very difficult to sort of put aside. In India, every 30 days, there are close to 1 million people that turn 18. That's not going to change because of Brexit or President Trump's politics. That's not going to change because America becomes more isolationist in the way that it does trade with the rest of the world. These people want jobs. They want to come into the middle classes. They want to consume. And because they want to do that, if certain economies are not prepared to trade with them, you will see an explosion in the coming decade of South-South trade as well. In Saudi Arabia, the mobile penetration rate today is somewhere between 150% and 175%. And it's not slowing down either, it's growing. So the opportunity that we see fairly aggressively and fairly strongly is in South-South trade. People in the global South have confidence in what they can produce, where they can innovate. The last decade and a half of globalization has meant that technology has actually resulted in a fairly open platform architecture of knowledge transfer. And so a lot of innovation and production is actually happening in those markets. And the people in those markets actually have realized and know that they're already on the world stage. What's happening in the US and Europe actually, in my opinion, has accelerated the growth of people in these markets to believe that they can look after themselves. So my inference from that is that much of the growth that is going to happen in these markets is going to come from within. And so in simplistic terms, the choice doesn't go from us or them. The choice doesn't go to all of a sudden. What it actually says is it's been happening for a while. The pie is not finite. It keeps growing, and the opportunity within these markets is growing as well. So on a macro basis, I hope what I've shown you is that the opportunity is not only there, it's growing, but these markets continue to be very prosperous. When I talked about the global brands, the point I didn't tell you is that with all of their aggregation and the products that they produce and innovate around, they represent less than 40% of the marketplace for consumer goods in those markets. 60% of the consumer goods in those markets are sold by businesses that are local to those markets themselves. We own a business in Nigeria and Ghana called Fan Milk, which is actually a better known brand according to Nielsen than Coca-Cola. That's one example. I can give you 1,000 other examples of businesses that in their domestic marketplace are extremely well known. That is the opportunity for private equity. That is the scale at which private equity can play, and that is where the private markets represent the greatest investment opportunity in these markets. If you take the public markets and aggregate them across all of these markets, I'd like to say, and I'm probably inaccurate, but you'd probably add up to all of these markets being equivalent to the market cap of Facebook and Google and Amazon and a few other companies put together. The reality is it's not public markets that drive that world, because public markets are usually a result of 10 or 12 companies in each market dominating the local stock market and representing 50 or 60% of it, and usually those companies are not from the sectors that are exhibiting the real growth in these markets either. The consumer businesses, the financial services businesses, the logistics businesses are not yet participants in the stock market. Now, how do I say that with so much confidence? How do I say that the time for private equity is strong and it's now? We've seen that from 2011 till today, we did an exercise in understanding what transactions are actually happening in these markets. We took China out of the discussion. And what we saw was $470 billion of transactions happened in these markets across 2,300 distinct opportunities. And that in itself speaks volumes around where the opportunity is. But interestingly, and this is the fact that a lot of people didn't realize, is close to a third of that money that was invested in businesses that in investment opportunities that were more than $500 million at a time. Now, what that is telling you is scaled investment has arrived. It exists. It is being done arguably by different pockets other than private equity, but it is happening at the same time. And if you share the views that I am expressing, and if you think through the mechanics of what private equity investing in these markets is and how you aggregate these markets, then we have to understand that we cannot look at these markets in totality as one composite body. I've broken it down into three. You can probably break it down even more granularly. You can probably be even more granular in the opportunity, but something that we often forget when we're looking at the headlines on CNN or the hysteria that often forms around markets. As I said earlier, when risk comes in the global financial system, it often comes in the West. We forget that the Lehman Brothers and the crisis of 2008-9, where did it happen? Think back genuinely and try and recall when individual crises in individual markets rocked the global financial system. It didn't. And yes, we have had currency displacements. Yes, we have had governmental changes in different markets. But you price those in to the investment decision making that you're making at the outset as well. And then you look at the efforts that are being made in these markets to reform. When you look at the opportunity that that throws up, you look at the level of subsidy reform, for example, that is happening today in India, in Indonesia, in Egypt, in Saudi Arabia, and you realize that all of these countries have the same objectives that leaders in the West have, which is to make their world, their countries, a better place for their own citizens. And that is happening again at an increased pace, thanks to the fact that the young populations that I was talking about are very, very impatient. And what is happening with young populations across the world is they have a sense of community, whereas most of us grew up with a sense of hierarchy. This sense of community means, thanks to Facebook and social media, that they know what's happening everywhere else around the world as well. And because of that, they have a very clear understanding of the speed and pace at which their own countries need to change. And that in turn leads to economic reform, and that leads to business opportunity, which people in this room are in pole position to experience and enjoy. Now, this is not happening at the same uniform pace around the world. It's happening in different markets at different speeds. The real, if you like, value proposition that all of us have to face is to know the markets we're investing in, have the opportunity clearly defined, don't rush in because everyone else is rushing in, don't fall for acronym investing. What does BRICS mean? Yes, of course, a lot of people made a lot of money following that hypothesis, but Brazil and Russia have very little to do in common with India and China. And therefore, you look at each country in isolation, you look at each opportunity based on the growth that you experience in that economy, and what you will find is there's enough out there from an investment perspective to be able to get very, very decent rates of return. Now, one of the things that you have to look at when you look at these markets is you have to address inclusive growth as well. Stakeholder engagement in these markets is crucially important. You cannot just be an investor and seek the financial return. You cannot be someone that comes in and pops on a lot of leverage onto a transaction and hope for the best. You cannot be a private equity firm that enables companies to slim down jobs very rapidly. So you have to have a very inclusive approach to investing at a micro level. You have to be very driven by stakeholder engagement. You have to be focused on things like climate change. You have to be focused on things that have long-term positive impacts on domestic societies. And people that think in that manner are the winners in the private equity space today and have been able to scale their platforms as well. Now, I refer to this as partnership capital. Now, from the perspective of this industry, we all call it the private equity industry. I don't exactly know what private equity means, but for me, we've lost the essence of understanding that LP actually and GP, there is a word called partner involved in both of those letters and abbreviations. And if you treat the companies you buy as partner companies, if you remember that the people that gave you the capital are partners, and if you remember that the people that are deploying the capital are partners too, then you will realize why partnership capital acquires a significantly greater resonance and an understanding of the industry in those markets. The final point I want to make about those markets is we talked about disruption. We had a panel here earlier about the opportunities created by technology in the investing landscape. And what I'd like to say is, in particular, disruption is going to have a major impact on those economies in emerging markets as well, because you will have the ability to leapfrog some of the most stubborn and pervasive issues that are facing humanity as well. So you watched M-Pesa in Kenya. simply because Kenya went from 0G to 4G, and the ability to implement technological innovation was massive. And I'd like to invite you to think about just one small little fact. Any one of you, when you take off your private equity mantle or your investor mantle and you go home and you look at the expenses that are inherent in the way you live, you will realize that you are no different from the rest of humanity, which is 80% of your household income is spent on 4 basic categories, which are healthcare, education, housing, and food. Healthcare, education, housing, and food. 80% of your expenditure is in those industries. Disruption, technology is focusing on those 4 industries. Again, if you think about the fact that if as a result of changes in disruption and disruption caused by technology, if that 80% becomes 70% or 60%, that 10% or 20% release of expenditure that you were doing in those areas is actually going to go to consumption, specifically in our markets. That unleashes an entire new wave of opportunity of investing as well. So when you look back at these markets, when you look back at our industry in these markets, you realize that ours is a nuanced industry. We see opportunity where others don't. We focus on the micro. We focus on the specific partner that we're investing in the company in question. We help grow them. The nuances don't stop at that point. The nuances in emerging markets go beyond that, and you have to have a very local knowledge, a very local presence to be able to deal with them as well, address them. And what I'd like to say in conclusion is together, all of us can redefine these markets. We can redefine them through the power of the capital that flows through the private sector, that flows through the private equity industry. We need to allow the flow of capital, trade, and people, not deny it, as some would have it. And in my view, the role of business today is to actually make that point a little bit more forcefully than it has been making so far, and do so in a manner that is inclusive across the planet and enables all of us to become better citizens globally. And I think the role of the private equity industry as yet has not focused on that element, which is both stakeholder engagement and being a force for good. I hope more discussion happens in that field in the years to come. Thank you very much.